Right, well, turning now to our top story, cooling inflation, raising hopes the Fed could hold or even bring down rates. That optimism shared by Gary Cohn, former NEC director, who says the worst of the trouble with the banks may already be behind us. Take a listen.
We're more acutely aware of what's going on now because we've seen larger banks, much larger banks, run into financial trouble, and we've seen larger banks go out of business. I don't think we have seen the end of this banking situation. I won't call it a crisis because I don't feel like we're in a crisis.
Our next guest, however, says increased spending, the fallout from recent bank collapses, and yes, still high inflation are creating storm clouds on the horizon. Joining us now, Nouriel Roubini, Stern School of Business, New York University professor, Emeritus. Thank you for joining me this morning. So I first want to get your reaction to where we are in this banking crisis and the repercussions.
I think the worst is still ahead of us. The business model of many regional banks is broken. They have a narrow deposit base. They have a large amount of uninsured deposits. They had massive losses on their securities. Even the value of their loans is falling. They have exposure to commercial real estate. And many of them, if you measure it correctly, given the changes in interest rates, are now insolvent. If they have to raise money, not at 50 basis points on their deposits, because people can get 4 or 5% on safe money market T-bills, then you have a problem in terms of cost of funding and value of their assets. So I think that the worst in terms of severe banking stresses is still ahead of us. And of course, this credit crunch is going to reduce significantly economic growth. They lend to SMEs, they lend to households, they lend to commercial and residential real estate. That credit crunch is going to tip the U.S. economy into a recession later this year.
And I mean, we still don't know exactly how long these repercussions will last, but some not quite as pessimistic. In Jamie Dimon's annual shareholder letter, he noted that there would still be repercussions from the banking crisis for years to come. It does raise recession risks, but he said nothing like what we saw in 2008 because it involves far fewer financial players and fewer issues that need to be resolved. Is there something missing there from this picture?
Well, compared to 2008, now we have inflation. At that time, we didn't have inflation. We have had a number of negative aggregate supply shocks that reduce economic growth and increase the cost of production. So at that time, we had a demand shock, a credit crunch, deflation. We could do massive monetary, fiscal, and credit easing. Now entering economic contraction when inflation is too high and the Fed has to keep on hiking. Even before these banking stresses, the Fed was facing a dilemma because either you raise rates to fight inflation and you cause a recession, or if you care about job growth and you don't raise rates enough, then you have a de-anchored expectation. Now the dilemma has become a trilemma. In addition to price stability, maintaining growth, we also need financial stability. And as you raise rates, you create more stresses for both creditors and for borrowers. And therefore, you have only one policy instrument, in this case, the Fed funds rate, to hit three targets: price stability, growth, and financial stability. To me, that looks like mission impossible.
And you mentioned this trilemma there. So you have the looming insolvency crisis, recession risks, inflation as well. But you also do have a much stronger consumer now than you did in 2008. But you say that a doom loop is coming. Is it not avoidable then?
Well, among the households, there are those who are doing better off. But the bottom 50% of the household sector lives from paycheck to paycheck. The average household has only a few $100s of liquid cash spared. That's savings during COVID, but they spent a lot of it. Real wages have been falling because wages were growing less than inflation. And there is some meaningful amount of financial fragility. Anybody who has a consumer loan, a credit card, an auto loan, student loan, or mortgage at a variable rate now is facing much higher debt servicing costs. So we're starting to see the buildup of fragilities for at least half of the household sector as well.
So what can central banks do at this point? I mean, we saw the IMF raising risks as well about even the vulnerabilities of non-bank financial institutions as well, and talking about how much the global financial stability hinges on that as well. What can central banks do?
Well, right now they're in a trap because either they raise rates even more, and even today's inflation report suggests that core inflation is still at 5.6%, well above 2%. If you raise more in order to fight inflation, you cause an economic downturn. This is going to lead to more non-performing loans and more financial stresses. And more financial stresses in financial markets, banks and non-banks, are going to imply a more severe economic downturn, so economic and financial crash. Or if you care about growth and about maintaining financial stability, you stop raising rates when inflation is still too high. And then over time, you get a de-anchoring of inflation and inflation expectation, and you get a wage price spiral. And then you end up like the 70s with inflation remaining high, eventually recession. But in the 70s, we had stagflationary shock, but debt ratio were low, 100% of GDP, private and public. Today, there are 420% of GDP. After the GFC, we had a debt problem, household, housing, mortgages, banks, but we had a negative demand shock that was deflationary. Today, we have the worst of the 70s in terms of negative supply shocks and debt ratios that are significantly higher than they were even during the global financial crisis. That's why I do worry there's going to be a great stagflationary debt and financial instability. We have the worst of the 70s and the worst of the post-GFC period.
And some of these other mega threats that you mentioned, what we're seeing in terms of countries engaged in what you call various wars, some real, some metaphorical, and talk about the domino effects on that and what that might mean for investors.
Well, we are in a geopolitical depression. There is already a hot war with the brutal Russian invasion of Ukraine. This spring, this war is going to get worse, potentially further shocking commodity markets. I was recently in Israel, where it's clear that Iran has become a threshold nuclear state. If Israel were to attack Iran, you'll have a spike in oil prices worse than 73 or 79. And I just visited China, where unfortunately the Cold War between US and China is getting colder by the day. And this geopolitical depression is leading to a fragmentation of the global economy, decoupling, protectionism, deglobalization, balkanization of global supply chain. We've gone from free trade to secure trade, from offshoring to friendshoring, from just-in-time global supply chains to just-in-case, and from caring about economic efficiency to talk about economic and geopolitical security. These things are costly. They reduce global growth, they increase cost of production, and there are forces that, among others, are stagflationary for the real economy.
And I mean, we're seeing countries having to take sides as both China and the US trying to push forward with technological advancements. But obviously, the US dollar is still the predominant global currency, reserve currency. But as people do sort of take sides in this dynamic, what lies ahead then for the dollar and the multinational companies that are essentially stuck in the middle here?
Well, we had until now a unipolar global reserve currency where the dollar was dominant. But it's clear that China and its allies, revisionist powers like Russia, like North Korea, Iran, Pakistan, and others, want to build an alternative global monetary and reserve currency system because they worry that the kind of sanction we imposed on Russia, if there was a conflict or escalation over, say, Taiwan, could be imposed on China. And China has over $1 trillion of reserves that are in dollar. So they need to have a unit of account, a means of payment, a store of value that is alternative to the US dollar. And they're going to start to build it and already talking not only to their own allies, but also other friends that do business like those in the Persian Gulf about pricing oil in RMB, paying it in RMB, and building reserves in RMB. That's going to take time, but I think that gradually over time, we're going to have a process of a movement of a unipolar global reserve currency system to a bipolar, where you're going to have US, Europe, the West based still on the dollar, but then the Chinese are going to build the RMB as an alternative to US dollar. That means less financing of our own twin fiscal and current account deficits when we still have very large stocks of private and public debt that can push higher the cost of financing for the United States when we have very high private and public debt ratios.
So a lot of dynamics and nuances at play in this relationship investors should be aware of. Nouriel Roubini there, Stern School of Business, New York University Professor Emeritus. Thank you for joining us on Yahoo Finance today.
Great being with you today.